We all have heard stories about how the 10 rupee stock made its way to rupees 50. So high return, but at what risk, at what cost, and how long did it take? Hello everyone, welcome to Formulating Finance. If you're new to the channel, please like, share and subscribe, and do hit the bell icon for more updates on the videos. In this video, we will be discussing about penny stocks. Penny stocks are usually associated with small companies listed on stock exchanges, and price can be as low as rupees 10. Characteristics of a penny stock: very low price, low as 10 rupees as well. Investing in these stocks is comparatively cheaper. Very low market capitalization. These stocks are traded infrequently, so they lack liquidity. Highly speculative nature. Less governance structure. More riskier than large caps and mid caps. Less regulatory standards are followed within the firm. Comparative advantages of investing in a penny stock. High returns. These stocks provide higher returns compared to others. As such, shares are issued by small and micro-cap companies. They have vast potential for growth. Consequently, penny stocks are risky, given its intensity of response to market fluctuations. Low funds are required. Penny stocks are usually priced lower than $10. Therefore, you could purchase a substantial amount of stock units from penny stock list with little investment without losing any significant portion of your investment finances. Fundamentally, if we see, penny stocks have low price to earning ratio and very low price to book value ratios. There is a high risk reward ratio, which means you get rewarded only if you are ready to bear that high risk. They are usually issued by small companies where growth potential is quite high. Example: I bought 1000 units of stock for 10 rupees and the company performed so well and price went up to 11 rupees. Profit per unit would be 1 and total profit would be 1000 rupees. Now let's see an alternative scenario. Suppose the company performed badly and the price dipped to rupees 8. Loss would be rupees 2 per share, but total loss would be rupees 2000. Penny stocks are multi-bagger stocks. Some of these stocks have the potential to evolve into multi-baggers. It means shares which yield in multiples of the investment amount. If specific security reaps double its investment amount, it is called double bagger. And if it returns 10 times its investment value, it is considered a 10 bagger. Very less amount of funds are required to invest in penny stocks. Higher number of units can easily be purchased with a small amount of investment. Disadvantages of investing in a penny stock: high tolerance of risk. Investors should take particular precautions. For example, an investor should have a stop loss order in place before entering a trade and know what price level to exit if the market moves in opposite direction. Lack of information is available to the public. There is limited information available on the company's financial soundness or track record, past performances, growth prospects, etc. A thorough research would be required before investing in a penny stock. Penny stocks have a high probability of fraud and bankruptcy of the underlying company and usually have bad corporate governance. These stocks heavily rely on market conditions for growth in their value, which makes industry growth as a big determinant of its success or failure, as these stocks are not the leaders but the followers. Penny stocks lack liquidity. Lack of liquidity can be of two types. First, investors may find it difficult to sell stock because there may not be any buyers at that time. Second, investors might have difficulty in finding a price that accurately reflects the market. Penny stock scams are very common. One such popular method is pump and dump. Scammers purchase a considerable amount of penny stocks, resulting in high demand in these stocks and increase in the price. And this attracts other investors to follow the hype, and we see the scammers dumping these stocks as they lack potential. So far, we have discussed about the advantages and disadvantages of penny stock. But what about the company itself? Do they get anything? Stock exchanges offer a place for these small companies to gain access to public funding, and sometimes this might prove to be really helpful in continuously running their business. But the question remains, why should you invest in penny stocks? The answer is simple: buy now or regret later. Penny stocks can be considered a hit or miss security. Companies issuing them might grow into a large organizations and yield higher than average returns, or tank in the initial years, incurring huge losses. Let's see how to pick winning penny stocks. First, decide if penny stocks are right for you. The first thing that you need to think about is that whether you are ready to take such high level of risk. If you find them too risky or out of your scope, then walk away from such choices. Second, understand the markets. Investing in penny stocks require a good understanding of the stock market and the pattern of the economy. External factors like wars, tension between countries, pandemic like corona we recently faced can hit the sectors, and penny stock would be the worst hit. Hence, investors with a sound understanding of the stock market are usually better at picking penny stocks than new people. Third, research. First, you need to create a criteria that can help you identify the industry, sector, etc. to create a primary list of stocks that you want to consider which fits in your budget as well, and then doing the research as per your criteria. Fourth, use metrics to assess the financial strength. Some of the metrics are book value per share. It is calculated by dividing the net worth of the company by the total number of outstanding shares. Price to earning ratio. It is calculated by dividing the stock price by company's earning per share. This can help you understand if the company is overvalued or undervalued. You can also look at the free cash flow to assess the intrinsic value of the share. Also, look at the competition, efficiency of the management team, free cash flow management, financial records, and other fundamental factors to understand if the company can do something to change the investor perception and is a game changer. Hence, while investing, it is important to consider factors internal as well as external to assess its true value. Beware of constant dilution. Smaller companies might raise capital more frequently or issue employee stock options to attract good talent. All this can lead to a dilution in the ownership percentage of existing investors. Let's say that a company has issued 100 shares to 100 shareholders. Each shareholder has a 1% share in the company. Now, let's assume that the company wants to raise more capital and issues 100 more shares to 100 new shareholders. This will bring down each shareholder's value to 0.5% and also cause the share price to drop due to more supply of shares. Hence, if a company is constantly issuing new shares, then the value of shares held by the existing shareholders will drop. Avoid companies that have a history of constantly changing its share structure. Know your investment horizon. Penny stocks are not recommended for intraday or short-term positions. Even if the company is doing well financially and has earned good respect, changing investor perception takes time. Therefore, beware if you are here in the stock market to make quick bucks, this is not your area. And if you have long-term investment horizon, try penny stocks. 7th, monitor your investments regularly. Penny stocks can be a great way to understand how the markets respond to a company's performance or macroeconomic factors. Hence, you have invested in a portfolio of penny stocks, monitor them regularly. This will help you to understand trading patterns and make better investment decisions in the future. Here are some of the penny stocks and the returns they earned. On research, you may find many such penny stocks. Thank you for watching the video. I hope you got insights of the penny stock and will help you to invest well. Please like, share and subscribe to my channel Formulating Finance. Thank you all.